Hello, welcome back. I hope you guys remember what was discussed in the last class. But let us just quickly have a brief overview on the discussions that we had in the last class. So, last class we had a comprehensive overview of concept of capital budgeting, and we also discussed some of the broader concepts which the capital budgeting is part of. So, if you have to recall what capital budgeting is, so capital budgeting provides certain techniques through which we do an assessment of risk and return associated with investment proposals. So, as the very meaning of budget, if you examine budget, the meaning, a budget is basically an estimation. So, same thing we do here also in capital budgeting. We are basically doing an estimation before investing itself. We are preparing a budget, and this budget aims at determining the risk and return associated with investment proposal. So once we have a solid view as to what would be the probable return and what are the risk factors associated with the investment proposal, the finance managers are in a better position to take decisions, right? So that is what exactly we do in capital budgeting. So last week we discussed a couple of concepts of capital budgeting, and we stopped on a concept called techniques of capital budgeting or methods of capital budgeting. So in today's class we would be continuing with the concepts which we could not do last week. So in today's class we'll be discussing about time value of money, and we'll also discuss one of the modern methods of capital budgeting, which is net present value, also popularly known as NPV. So in order to understand NPV, one should have a complete understanding of the concept of time value of money. And therefore, let us first understand what exactly the time value of money is, so that you are better prepared to understand the concept of net present value technique of capital budgeting. So I'm giving you three situations, and let us do a critical evaluation of all these three situations. What happens if you choose any one of these alternatives? So assume that you are a business and you have supplied goods on credit to your customers worth 1,000. Right? This is to a specific customer to whom you have given credit worth 1,000. And you, of course, every credit sale has some terms and conditions. So let us say this credit sale also has such terms and condition. So after the terms and conditions being examined, the customer generally buys the product, and also he agrees to abide by the terms and condition. So customer get backs to you. Basically, you have given customer a duration of 3 months to repay this 1,000 rupees, and unfortunately, this 3 months duration is over, and customer wants more time to repay this 1,000 rupees. So now the customer has given you three options. So let us see what are these three options. Option number one, customer is willing to pay right away, immediately, and if the customer pays, of course, you'll get back your 1,000 now. Option 2, customer will pay 1,090 rupees after a duration of 1 year. Or option 3, customer will pay you 1,150 after a duration of 2 years. Now, of course, this is a very easy scenario for you to come to a conclusion, but we have to discuss this scenario from a broader perspective by taking into account the time value of money, right? So, which option would you go for? Would you go for getting that 1,000 rupees now, or would you opt to get 150 rupees extra and get the same amount after 2 years? Which option seems to be better? Now, in order to answer this question, this might seem to be a simpler example, but let us say, right, you face similar situation, right, in your life. Basically, generally what happens in case of banks also offer you such schemes, wherein banks tell you that if you give us 10,000 rupees now, after 5 years we'll give you 13,000 rupees with returns. So should you invest in such investment schemes wherein the banking wherein the bank is telling you that you would end up getting more provided you should wait for a certain duration. So in that case, if bank is giving you 13,000 rupees by taking 10,000 rupees now, of course you are making a profit of 3,000 rupees, but this 3,000 rupees profit comes with a duration. That is, you have to wait for 3 months. Sorry, 3 years. So now let us get back to this situation. Let's see what happens. If you any decision, especially in which the amount of money what you're supposed to get is getting postponed, and also there is a benefit associated because you're waiting for certain duration, you have to take such decision by keeping into account certain factors. So let us list out these two important factors. Factor number one is called loss of investment opportunity, and factor number two is called loss in the value on account of inflation. So let us say if I am asking the customer to pay after 2 years, of course I would be getting this 150 rupees extra. But what is that I would be losing? Instead of getting that 150 rupees extra and waiting for a duration of 2 years, obviously I can invest on my own. Right. Now let us say I have one of my a friend who says that please give me 1,000 rupees, and in 3 months I'll return you, and at the end of 3 months I'll give you 1,200 rupees. So in case if I have such an opportunity wherein I'm able to make more money than what I would be making in the future, then obviously the option what the customer is giving would make it worthless, right? So whenever you are taking such decision, you have to always keep into mind what is that the opportunity that you are losing. In the other example which I told you, in which you're depositing 10,000 rupees in a bank, and bank is giving you an offer that after 3 years the bank would give you 13,000 rupees. So should you accept that offer? Generally, that is how it works. In most of the fixed deposit, you have to keep money in the bank for certain duration, on which you get certain amount of interest, and at a later period of time, the bank would return your money back. Whether the option which I have given on the screen, or whether the example of bank, more or less both are on the same. Both explains you the same concept. So in case if it is a bank, and bank is telling me that the bank would give me 13,000 rupees after 3 years, should I go for that option? The answer is the decision has to be taken by keeping into mind these two factors, right? Now, if I go for the offer given by the bank, that is, bank is giving me 13,000 rupees after 3 years, probably the 3,000 benefit what I am getting, that I am getting it in the future. In order to get that future benefit, I may have to forego if there is any investment opportunity available. So, what are the other investment opportunities that might be available? Let us say by investing the same amount of 10,000 rupees, or in this case, 1,000 rupees, I may make more profit in the stock markets, provided I should have the ability to take the risk. I should have the risk taking appetite. But let us say if I'm a investor who says that I don't want to take risk, then I may have to find out a better alternative investment that offers me a better rate than what the customer is willing to give me, or the bank is willing to give me, right? So in our example, bank is giving us 13,000 rupees after 3 years by taking 10,000 rupees. That means the bank is giving us 10% interest. So in case if I have a better investment opportunity that gives me 12%, but still I go with the bank, that means that I am losing this investment opportunity. The second factor that which you have to consider is inflation. Right? Imagine this customer gives us 1,150 after 2 years. Definitely the value of this 1,150 would have reduced at the end of 2 years. You know why? The answer is simple, on account of inflation. Inflation makes things expensive. On the other hand, it reduces the value of your money. So you have basically lost your purchasing power on account of inflation. If you have 1,000 rupees now, probably in this 1,000 rupees, let us say 3 people can go and watch movie. But let us say after 2 years, it might not be possible because the prices of movie ticket would have become more expensive on account of inflation. Right? So these are generally the two factors that is kept in mind whenever we take investment related decisions. right? So whenever you have been given an offer wherein you're getting the money in the future and the benefit also in the future, in such case you have to do an evaluation of such option by taking into account these two factors. So what happens here? So let us do an evaluation. So as I told you, in case if the customer keeps the money in the bank by accepting the money now, will it benefit more than what the customer is giving? Let's do a quick evaluation. So if I say the customer, boss, I don't want my money after 2 years. Give me that 1,000 rupees now itself. So I take the 1,000 rupees. I keep this 1,000 rupees in a bank, and the bank is giving me 10% interest. So what happens in this case? At the end of 2 years, I would end up earning 210 rupees, which is more than what this guy is offering to me, which is 1,150 rupees. From the viewpoint of assessment of risk, customer, right, you never know. He may or he may not pay, right? So there is a chance of default. But in case of bank, right, nationalized banks are much safer, right? So this option seems to be much safer. So in this case, what I have to do is probably I may end up choosing an option wherein I ask the customer to pay now itself, considering the fact that there is an investment opportunity to earn more money than what the customer is paying. So this entire concept, what you have just gone through, is called the concept of time value of money, which says that the money what you have now is more valuable than what you will have in the future. Let me repeat, the money what you have now is more valuable then the money what you have is more valuable now than what you will be having in the future. The reason, the money which you have now gives you an opportunity to earn. Second, the money which you have, which you will have in the future, will get reduced or devaluated on account of inflation, right? So this concept is called the concept of time value of money. So whenever you take investment decision, it is more practical for you to consider time value of money. So that's the reason why most of the investor advisors generally say that fixed deposits are generally not good investment avenues. You know why fixed deposits are not good investment avenues? Because the moment you keep the money in the bank and withdraw that money after a few years, even though you would have earned interest, but interest plus your principal amount put together after a certain duration, it will have lesser value on account of inflation. On the other hand, investment options such as shares, right, would definitely defeat inflation because shares, what happens, you have the opportunity to earn more, right? There's a possibility that 100 rupees share after 3 years might become 500 rupees, right? Even if you take into account inflation, still your investment has more benefit because shares as an investment avenue, right, has the ability to absorb inflation. The thumb rule of investment says that the rate of return what you are earning from your investment should be more than the rate of inflation. So that is the general thumb rule which we follow. So we apply the same thumb rule here in investment decision also. The investment avenue in which you are planning to invest your money, that investment avenue should offer you a rate of return which is more than the opportunity cost, which is more than the rate of inflation. If these two conditions are satisfied, then that investment option would be considered as an ideal investment option. Right? So I hope you guys would have understood what time value of money says. Let me reiterate. Time value of money says that the money what you have is more valuable now than the same money which you will have at a later period of time on account of one, that at present you may have investment opportunities that will help you to earn more money. Second, that the money which you receive in the future is subject to inflationary risk. So therefore, whenever we do investment decisions, we have to take into account the time value of money. So why it is important to understand the concept of time value of money? As I said, understanding time value of money makes your investment analysis more practical, right? So that will actually will help us to measure what is the real worth of our investment in the future, which we are going to decide now. Second, it will also help you to evaluate your financing decisions. What we have done just now is we have done an evaluation of a financing decision, whether to accept the money now or whether to ask the customer to pay the money at a later date with certain amount of interest, you can say. Third, it will also help you to do an assessment of credit policies, right? So as far as credit policies are concerned, we have a separate chapter called working capital management, in which we have receivables management. So when we discuss this chapter, receivables management, probably we'll have an elaborate discussion on credit policies, right? So I hope you are clear with the concept of time value of money. So the concept of time value of money can further be classified into two categories. One is called the future value of money, and the other one is called present value of money. So let us understand in detail what this future value of money is and what this present value of money is. So when we say future value of money, it means the amount and the benefits from your investment which you would be receiving at a future date. So in our preceding example, this 1210 rupees, this 1210 rupees is called the future value of money, right? So this is the benefit what we would be receiving in the future by investing our money now. So if I invest 1000 rupees now, this is the benefit what I am going to get in the future. So this concept or this money what I would be receiving in the future is called future value of money. So that's a very simple concept. So let us do another example here. So Mr. X is a finance manager of ABC Limited, and there is a surplus fund sitting in the account which is 10,000. So this finance manager takes a call to invest this 10,000 rupees in the bank. Probably is going to do a deposit on which he is earning 10% interest per annum. So the question is, he's keeping the money for 5 years. So at the end of 5th year, how much he will receive? So the amount what he is going to receive in the future by investing the money now, that money is called future value of money. So the calculation is simple. All we have to do is calculate the interest amount. So there is a equation here to make things easier, which is future value uh, future value, which has to be calculated by taking into account the principal amount which is being invested. So P stands for principal. So your principal amount is 10,000 plus the N. N here is the duration. R here indicates the rate of interest. In this example, it is 5. And P here indicates the principal amount on which the person would be earning the interest. So FV here stands for future value, and N indicates the duration. So what is the future value at the end of 5th year? Let us calculate. So the future value at the end of 5th year would be 15,000 rupees. So point to be noted here is that this 15,000 rupees includes the principal amount, which is 10,000, plus it also includes the interest earned. So both put together, what would be the worth of investment in the future is called the future value of money. So the concept is simple, right? I hope you guys have understood this. So now in future value of money, we again have two kinds of interest. The previous example, what we saw is a simple interest. But sometimes the banks can also offer us compound interest. Certain investments has the benefit of compounding. So what happens exactly in compounding? In simple interest, you get the interest on the principal invested. So in this example, we have invested 10,000 rupees on which we are getting an interest of 5%, right? So this 5% interest on 10,000 is called simple interest. But what happens in case of compounding, also known as compound interest, you get interest plus interest on interest. So let us do a small modification to our previous example here. Instead of 5 years, we are considering the duration as 3 years, and see how much money the person will earn by investing 10,000 now. So if you do the calculation here, the calculation is simple. First year he will earn 10% interest, and this comes to 1,000 rupees. So at the end of the first year, what is the future value of money? The future value of money at the end of first year is 11,000. So what happens in the second year? On this 11,000, he will earn 10% interest again. So the point here is, in case of simple interest, you always earn the money on the initial investment of 10,000. But here you are earning the money on principal amount plus the interest amount what you have earned. So you get interest on interest plus you get interest on principal also. So this is how the calculation works. So at the end of the third year, the future value of money is 13,310 rupees. So should you accept this investment proposal or should you reject this investment proposal? Because the whole purpose of time value of money is to consider the opportunity cost and also the rate of inflation. So after accounting both, you should be in a position to earn more, right? So as I said, the thumb rule is that the investment where you're planning to employ your funds, that investment source should generate a return which is more than the opportunity cost and which is more than the rate of inflation. So here the money which the SSC has earned is not actually 10%, it is more than 10% because the SSC has earned both interest plus interest on interest. So if you do calculation here, let us see what is the rate of return, the effective rate of return. So SSC has earned 13,310 rupees, but what he has invested is only 10,000 rupees, right? So if you do a quick percentage calculation, SSC has actually earned more money, not at the rate of 10%, but more than this, right? So SSC has earned more money. So therefore, this amount what he has earned is definitely more than the rate of inflation, right? So if the rate of inflation is, let us say, 8%, so definitely this is more. And this is, he's not just earning 10%, he's earning interest plus interest on interest. So if you calculate the effective rate of interest, obviously it will be more than 10. So this seems to be a better investment decision, right? So this is how the calculation works. Now this table what we have done, right? This can also be done in a simpler fashion by using an equation which is listed out here on this slide. So future value of money is equal to P into 1 plus R to the power of n. So what happens here? P indicates the principal amount, which is 10,000, and R indicates the rate of interest, and n indicates the duration, and 1 indicates the compounding factor. So if you do the calculation, the amount would still be same, right? As you can see here, the future value of money would be 13,310 rupees, and the amount of money which the SSC has earned from his investment is 3,310 rupees. So this concept is called compounding. So in compounding, what happens? The value of money increases because you get interest plus you also get interest on interest, right? So in time value of money, as you can see here, we have two concepts. One, we have future value of money, and the other one is called present value of money. So what exactly present value of money is? So the answer is present value of money is a concept which is totally opposite to future value of money. In present value of money, you are trying to determine the current value of investment. You're trying to do an evaluation of an investment which you're making now, but this investment will reap you the benefit in the future. The evaluation is being done at current value by taking into account the future benefit, right? So this concept is called present value, or it is also known as discounting. So what happens here? The investment which we are doing now, from that investment, we would be incorporating two factors. One, we would be incorporating the opportunity cost which is being lost. Second, we can also incorporate inflation. So after reducing or after incorporating inflation factor and the opportunity cost factor, what would be the value of my investment now, which for which the benefit is received at a later date, right? So in order to do this, all we do is we slightly do a modification in the equation. So this is the equation for future value of money, and this is the equation for present value of money. So here there is a slight modification. So we divide the benefit is nothing but the cash flow, with the discounting factor. Whereas here we are multiplying the benefit with the compounding factor, that is interest plus interest on interest that gets accumulated every year, that gets compounded every year. So here we are assuming that the value of money which we would be receiving in the future will not increase but rather decrease. So why does the money what we are receiving in the future is decreasing, why it is getting discounted? The answer is on account of two reasons. One, because by investing the money in one particular investment, we are losing the opportunity to invest it somewhere else. Second, on account of inflation, the value of money can reduce. So on account of these two factors, what happens? The value of your investment will definitely reduce in the future. So here let us work out an example for your better understanding. So assume that you have identified an investment proposal uh, that would cost you 2,500 rupees. So this 2,500 rupees is your investment, and this investment proposal will give you a revenue of 1,800, 900, 600, and 500 in the next 5 years, assuming that the investment proposal life is only let us say 5 years as per this example. And the cost of capital can be various things. Whenever we do investment decision, cost of capital can be the cost of your the cost of financing the project. In other words, the money what you have to pay to the bank in the form of interest, or the money what you have to pay to your equity shareholders if the source of financing is through equity, or it can also be the opportunity cost what you are losing by selecting this investment proposal. Right, so it can be two things. Now let us say in order to fund this money, I am paying 10% to a bank because I am taking this entire money from a bank because I don't have my own funds. So in that case, what happens? The money what I am paying to bank is considered as cost of capital. But let us say if I have my own source of fund, I'm not borrowing money. It's my own money which is there in the account which is being accumulated. In that case, what happens? I have two options. Option number one, either to invest this money what I have saved in this investment proposal, which would cost me 2,500, or option two, safely keep that money in the bank and happily earn interest every year. Put the money in every and earn interest. So if I am putting this money in the bank fixed deposit rather than investing in this proposal, how much will I earn from that bank deposit? So this 10% which I would be earning from bank deposit instead of investing in this investment proposal is also known as opportunity cost. So nevertheless, either it is cost of capital or opportunity cost, more or less it's the same, right? So the whole logic is simple. Remember, in order to calculate a capital budget, what kind of info do we need? We have already discussed this in the previous session. So we need cash inflow. Cash inflow is nothing but the revenue what is being generated from the investment proposal. What is the amount of money we are investing in the proposal is called cash outflow. It is also called as investment amount. Third, there is another point here which is required rate of return. So required rate of return is nothing but either your opportunity cost or your cost of capital. So simple, if I have to select this investment proposal should offer me a rate of return which is more than my cost of capital. Only then I will accept this investment proposal, otherwise I will reject this investment proposal. So in order to take a decision, I would be using the present value formula. So let us do a simple calculation here. So this is just for your understanding. This is the timeline. So here we are investing 2,500 rupees, which is nothing but our cash outflow, and these are the benefits what we will be receiving during the lifetime of the investment proposal for the period of next 5 years, which is also termed as cash inflows. So here is the calculation part, right? So now here if you see there are two things, right? So first here let us assume we are doing this calculation without taking into account the present value of money. Without taking into account the present value of money. So if we do this calculation without taking into account the present value of money, what happens? First year we will earn 1,000, second year we will earn 800, 900, 600, 500. That means at the end of fifth year, the life of the investment proposal is over. So what is our total revenue? 3,800. Last 5 years, 3,800. And what is that we have to spend? The answer is 2,500. So what is the profits made? The answer is 1,300 rupees is the profit what we are deriving from this investment proposal. So in this first part of the demonstration, we have not taken into account the present value of money, right? So present value of money is doing the assessment of your future sum of money now itself by taking into account one important factor, that is cost of capital, or also called as opportunity cost, right? But when we take this opportunity cost into account and then do the calculation, there will be a big difference in the result. So let us see what would be the result. So here in the second part of calculation, what we are doing, we are discounting, right? What is that we are discounting? We are discounting the future cash flow with the opportunity lost. Or in other words, we are discounting this future value of cash flow with our cost of capital. And cost of capital, again, cost of capital, the calculation is not being done at a simple interest. It is being done on a compounding basis, right? So when we do this, when we take this present value factor, what happens? The value of money reduces. This 1,000 rupees which we are going to receive at the end of first year, its actual value after discounting would only be 909 rupees. So same discounting factor we would be applying it for all the cash flows. Now after applying the discounting factor for all the cash flows, obviously if you see here, the revenue which gets generated in the 5 years is 3,011 rupees approximately. From this, if we deduct our investment amount, what we would be end up getting is only 511 rupees approximately. So this gives a better picture. This value is more realistic than the value what we have taken here, right? Here we have taken only 1,300, but here we have taken 510 rupees. So why in this example, in the second part of the example, the value of money is less? The reason is, in this example we have followed the concept of discounting. So the concept of discounting says the value of money which you will receive in the future would obviously reduce because you are losing opportunity cost, or you have to bear the cost for financing, and second of, obviously there is an inflation also, right? The money what you will receive in the future, obviously its value will reduce, right, on account of inflation. So this calculation seems to be little more practical than following the first calculation. The first calculation, the amount seems to be very big, but what you have not taken into account is the discounting. What you have not taken into account is the discounting factor. But here, since we have taken discounting factor into account, the calculation becomes a little more practical and the assessment also becomes more realistic. So let us do the same illustration with a different method. So in this method, what we have done, we have used this equation, which is present value equal to cash flow divided by discounting factor, right? So what is the cash flow on a yearly basis we have taken, and then this has been divided with the discounting factor that reduces the value of money. But alternatively, we can also do the same problem using the same present value equation, but here we do a slight modification. The modification what we do here is that instead of taking the cash flow amount which we are generating on a yearly basis, the way we have done here, 1,800, we are taking the value of 1 rupee. So what would be the value of 1 rupee at the end of first year? So the value of 1 rupee at the end of first year after applying the discounting factor would reduce to 0.909. So we are calculating here present values of rupee 1. After calculating the present value of rupee 1, we have to multiply this present values with the cash flows. So if I multiply 1,000 rupees, which is the value of the first year cash flow, with 0.909, I would still be getting the same answer, more or less. So the choice is yours. You can either follow this method, or you can either follow this method. right? So this method seems to be much more easier because this can be easily these present value factors can easily be calculated using your calculator, right? So the calculation is much easier to do, something which we have done in the classroom, right? So let us now do the same calculation here with the help of present value factors. So first we have found the present value factors by using this equation. We have found what is the value of rupee 1 at the end of first year, second year, third year, fourth year, and fifth year. So write down the value of 1 rupee and multiply the cash flows with the present value factors. So when you do this, the answer would still be same. So we would still be getting the net present value of 510 rupees, which we have got here. So that's how the calculation works. So present value concept is something which is widely used in the investment because this gives you a better picture for a simple reason that the money what we receive in the future, obviously that money will have lesser value on account of opportunity cost, on account of inflation. So it is better to do discounting rather than being very pessimistic. So I can't assume that this 1000 rupees after 1 year will have the same value. Obviously after 1 year the value of this 1000 rupees will have come down on account of opportunity cost, on account of inflation. So therefore this is a calculation which might look good because you're earning more profit here, but this is not practical because this does not consider the time value of money. Where this, even though the amount seems to be less, but this takes into account the time value of money. So this gives you better results, right? So whenever we are following capital budgeting techniques, something which we discussed in the last class, in these modern methods, we take into account time value of money, whereas in traditional methods, we don't take into account time value of money. So the first method of capital budgeting technique is called net present value method, something which we did here. This concept itself is called net present value method. So in net present value method, what is the acceptance and rejection criteria? So how do I come to know whether should I accept this investment proposal or whether I should reject this investment proposal? So the answer is simple. In case of individual projects, right? In case of individual proposals where you're not comparing, you have only one option. So in case of individual investment proposals, if the NPV is positive, if it is more than 1, you accept. If it is less than 1, you reject. If it is exactly 0, then in that case you have to decide whether you should go for it or you don't want to. But in case of mutually exclusive proposals, in case if you have 2 or more investment proposals, in that case what happens? You have to select the investment proposals which has a higher NPV. So point number 1, NPV should always be positive, right? NPV should always be positive. In case if the NPV is negative, then we don't select such investment proposals, whether it is individual investment proposal or whether it is a mutually exclusive proposal. So NPV should be positive. So here in this example, our NPV is positive, so we can select this investment proposal. Had it been negative, we would have rejected this, right? So that's how net present value method works. So now let us work out a simpler example. This example is something I think which we have done in the classroom, but let us do a quick recall because in the coming classes we will be doing little more advanced problems on net present value. So therefore this will serve as a simpler example, right? So this is the scenario. There is a footwear company which wants to buy a shoe molding machine for its manufacturing operations, and this shoe molding machine would cost 1 lakh rupees, right? So the shoe molding machine has a life which is 5 years, and at the end of 5 years obviously the machine would be sold, for which the company is getting some scrap value of 5,000 rupees. And in order to operate this machine for the next 5 years, you also need working capital that needs to be invested in the beginning of the in the first year, in the year in which you're buying the machine. At that time you have to invest 25,000, which you will get back because after 5 years the life of the machine gets over, so you no longer would require this 25,000 rupees. So you would recover this 25,000 rupees at the end of 5th year. So by investing this amount in the investment proposal, that is to buy a machine, these are the revenues which are anticipated. So these are the cash inflows. So your job is to calculate net present value and advise the management whether to accept this investment proposal or whether to reject this investment proposal. So as usual, whenever you see a question, we have to get 3 set of info. First, what is the cash inflow, which is given here. Second, what is the cash outflow? How much investment is required? The answer is 1 lakh rupees plus 25,000 rupees towards working capital. But this 25,000 rupees would be recovered at the end of 5th year. Third is the required rate of return, also known as discounting factor. Right? So these are different names. It is known as required rate of return, it is known as cost of capital, it is called as opportunity cost. So don't get confused. All has the same meaning. Right? Basically, we need a rate to discount our cash flows, and that rate is given here, 10%. So after discounting all these cash flows at the rate of 10%, we have to see what is the net present value. So let's do the calculation. So here is the picture in the form of timeline. This equation is something which you have to remember. This is the I would say a one-liner equation that would help you to solve any complex problem. So how do we calculate net present value? Simple. Total present value of cash inflows minus total present value of cash outflows. Right? Remember, we are not calculating just value of cash inflows and outflows. We are calculating the present value. So how do we get present values? After discounting the cash flows, we get present value of cash flows. Right? So this is the situation. In year 0, the year of investment, we need 1 lakh rupees towards the cost of the machine and 25 lakh rupees towards the working capital. So what is the cost of investing, or what is the cash outflow? 1 lakh 25,000. Right? So what is the cash present value of cash outflow? The present value of cash outflow would be 1 lakh 25,000. And what are the cash inflows we are receiving? 2219. I think, yeah, 2219.5. So the values are given here. So point to be noted here is that in the 5th year, you're getting 3 cash flows. One cash flow is being generated from the sales, which is 36,500. Another cash flow is being generated from the sale of scrap. Another cash flow is being generated in the form of recovery of working capital. And therefore, in the 3rd year, you have 3 cash flows. So let us do the calculation now. Right? So what we have done here is, we have first found what is the discount or present value factors. So if you remember, in the previous segment I had shown you how to calculate this. So let us quickly go there. Yeah, here it is. So how do we calculate this? So we calculate this by using this equation. Alternatively, we can also follow this method. Cash flow divided by discounting factor. Or find out the present value of 1 rupee and use those discounting factor values and multiply with them, and multiply them with the cash flows. So you can either use any one of these methods. So we have followed method number 2. So if you follow method number 2, this is what happens. So the present value of cash inflows is 1,10,825. So this is the present value of cash inflows minus present value of cash outflows, right, which is 1,25,000. So we are getting a negative NPV. So what is the criteria under net present value of method? If the NPV is positive, accept the investment proposal. If the NPV is negative, reject the investment proposal. So the calculation is simple. The reason why I said in the beginning that you have to remember this equation, because in this example, the working capital is needed in the year of investment. In the year of investment, the value of 1 rupee will be 1 rupee only, right? But what happens next year? Next year, this value of 1 rupee will reduce to 0.909, right? So that's the reason in the beginning of the year we don't do discounting, because in the beginning of the year the value of money remains same. So only in the end of the year, right, the value of the money reduces. And how does it reduces? Because we are discounting it with the discount factor. So let us assume working capital is required not in the year of investment. It is required in the 3rd year. So when we need working capital in the 3rd year, then what happens? This 25,000 we have to spend in the 3rd year. And what is the discounting factor of 3rd year? 0.751. So what happens here is, when I am calculating total cost of investment, I'll take this as 1 lakh. But I will not take this as 25,000 because this I need in the third year. So this 25,000 I will multiply with the third year's discounting factor, which is 0.751. So that's the reason this equation is very handy, because it clearly says total present value of cash inflows minus total present value of cash outflows. So in our example which I just said now, the 1 lakh rupees will remain 1 lakh. But in case if we are investing this in the third year, then the value of this 25,000 will reduce obviously, because we have to multiply this with the discount factor of the third year. So the bottom line is that here we have to reject this investment proposal, and the reason why we are rejecting this investment proposal is because the NPV is negative. Right? So this is an individual proposal. Here we are not comparing two proposals. This is only one proposal. So either we have to accept it or reject. But in case of two investment proposals, we have to compare and see which investment proposal has a higher NPV. So in case if proposal A has a higher NPV than proposal B, then we select proposal A. In case if both are negative, then we reject both. Right? So I hope you guys have understood the concept of time value of money. So let me repeat, what is time value of money? Time value of money says the money what you have now is more valuable than what you will have in the future. The reason why the money which you have now is more valuable, because you have investment opportunity. You can invest that money now and make more profits. Second, the money which you receive in the future will definitely be lesser, because the inflation will make your money less, right? It will reduce your purchasing power. So the money what you have now is more valuable than what you will have in the future. So the principle of net present value method of capital budgeting is based on the concept of time value of money, and therefore the cash flows which we are receiving in the future, right, are being discounted. Right? They are not being taken as it is, but they are being discounted. So this is called the concept of time value of money. So hope you guys have understood the concept of time value of money and net present value. So in the coming classes, we'll do a little more complex problems on net present value method, and we'll also do problems on other methods of capital budgeting. So take care. Goodbye.